All right, let's dive straight into this explainer and build a consistent rule-based daily trading routine right out of pure market wisdom. If you've been struggling to find your footing in the markets, or if you feel like you're constantly second-guessing your entries, well, you are in the right place. Today, we're unpacking a mentor's playbook. We're distilling a decade of trading experience from our source material into a highly structured, objective strategy that completely removes the guesswork. We've got 6 key building blocks to cover today: the mentor's objective rules, spotting trends, flipping support into resistance, our top 3 candlestick patterns, layering those setups, and finally using ATR targets for strict market discipline. Let's get right to it.
Part 1. The mentor's objective rules. Trading is about strict parameters, not guessing. We're kicking things off by completely resetting how you view market movements.
You know that terrible feeling when you're on a losing streak and your stomach is in knots? That's emotional guesswork. It's reactive, it causes anxiety, and it leads to totally random entries based on a gut feeling. To survive in the markets, we are tossing that out the window. We are shifting over to objective technical analysis. That means you have set-in-stone rules for every single action you take, backed up by methodical backtesting and consistent daily routines.
Look, I'm sharing a decade of market wisdom here. Trading will test your anxiety. You will absolutely be tortured emotionally at times when the market pushes up, then pushes down, almost hitting your stop loss before finally reversing. That is exactly why this routine relies on objective rules. You have to build up your emotional fortitude so the math takes over when panic tries to set in. Moving to part 2, spotting trends and pullbacks. Finding the market's directional momentum.
So how do we actually figure out the market's direction without just guessing? Well, every trend is just a series of 2 specific movements. First, you have impulsive moves. Those are the massive, aggressive price pushes into new highs or new lows. Second, you have the pullbacks. Think of pullbacks as just short little breathers the market takes right after those big, aggressive pushes.
This brings us to a strict, non-negotiable rule for identifying an uptrend. You absolutely must see higher highs created by impulsive moves, followed by higher lows created by pullbacks. But here's the objective key. As long as the market never breaks and closes below the lowest point of the previous pullback, your set-in-stone rule tells you that you are still in an uptrend, period. It removes all the subjectivity. If that lowest low holds, you are only looking for buying opportunities.
All right, part 3, support turns into resistance. This is the classic break and retest strategy. We know the trend now, but where exactly do we enter?
Visualize this sequence with me. Step 1, an impulsive move absolutely smashes through a previous ceiling, a resistance level. Now step 2, do not chase it. Just patiently wait for the pullback to drop exactly back onto that freshly broken ceiling. And step 3, watch as that old ceiling literally solidifies into a brand new concrete floor. Boom, you've got your new support zone, which is a fantastic area of value to look for trades.
Part 4, top 3 candlestick patterns. Time to identify specific triggers at key reversal zones.
When price hits that concrete floor we just talked about, we need a trigger. And listen, you do not need to memorize hundreds of obscure candlestick patterns with names like abandoned baby or 3 black crows. You just need a few objective formations that prove definitively that buyers or sellers are aggressively taking control right at these key market reversal zones.
So here's the mentor's top 3 list. First up, the 38.2% retracement candle. Second, the engulfing candle, which objectively requires a larger body than the previous candle, plus a color change. And third, the close above or close below candle. Now, the engulfing and close above patterns are incredibly powerful for sure, but let me tell you, that 38.2% retracement candle, it's an absolute game changer, especially if you're a beginner trying to stay objective.
Let's get into the nitty-gritty of exactly how this 38.2% rule works. If you ask 10 people to spot a hammer candle, you'll get 10 different answers, right? It's way too subjective. To fix this, you just pull a Fibonacci tool from the exact low to the exact high of a single candlestick. For it to be a valid bullish entry signal, the entire body of that candle must close above the 38.2% line. This completely removes the guesswork. If the entire body isn't sitting above that line showing clear buying pressure, you just walk away. Simple as that.
Part 5, layering high probability setups. We are stacking our advantages to create a massive edge.
A real, profitable edge in the market isn't built on just one signal. It's all about confluence. You only jump in when these 3 independent steps stack perfectly on top of one another. 1. Confirm the trend using our strict pullback rule. 2. Find that area of value where old resistance is now your new support. And 3, wait patiently for that objective 38.2% candlestick trigger to form right at that exact support zone. When all 3 line up, that's when you strike.
Finally, Part 6, ATR targets and market discipline, protecting capital and managing anxiety.
Getting into a trade is only half the battle. Once you're in, you have to manage risk without letting fear take the wheel. So we use the ATR, or average true range. This indicator calculates the exact average movement of a market over the last 14 candlesticks. Why is this so crucial? Well, if you use a static, tight stop loss on a highly volatile day, you're going to get stopped out prematurely 90% of the time. The ATR mathematically protects you from getting wicked out just because the market's throwing a bit of a tantrum.
Here are your set-in-stone, objective exit rules. For your stop loss, identify the recent swing low and place your stop exactly 1 full ATR value below it. That gives your trade room to breathe. For your take profit target, just take that ATR value, multiply it by 2, and add it to your entry price. By strictly following this formula, you guarantee a stress-free exit plan with the 2-to-1 reward-to-risk ratio. You calculate it, set it, and literally step away from the screen.
But how do you actually stick to these rules when real money is on the line? Relentless backtesting. Go open historical charts and manually apply this entire layered setup. Find the trend, find the broken resistance, pull the Fibonacci to check for that 38.2% close, and calculate the ATR. Verify this strategy on past data over and over. Make sure you record the key data points too: the date, the asset, the exact entry price, and your ATR value. Then go demo trade it. The only way to survive the psychological torture of an inevitable losing streak is to have tested these steps so rigorously that you trust the math way more than your fear.
And that brings us to one final crucial question before you ever risk real capital. The market is absolutely going to test you. It will shake you out. When that inevitable losing streak hits, are you going to cave and go back to emotional guesswork? Or do you have the actual fortitude to trust this mathematical, objective structure you just learned how to build? Honestly, start backtesting today and find out what you're made of.